How much magic does the Walt Disney Company still have left in the tank? There's a lot of questions out there from Wall Street analysts and publications alike, as you can see on the screen here. And today at 4:30 Eastern, we might just find out. The Walt Disney Company is set to drop its third fiscal quarter earnings report. And we will, of course, be covering it here live right here on Valiant Renegade. You can find the link to that live show in the description of this video. Make sure you click on it when you finish watching this video and set your notifications up. You don't want to miss this one. It's probably going to be one heck of a show, just like the last two. Renegade Online. Well, folks, welcome back. It's another great day here at Valiant Renegade. It's good to see everybody out there once again. And if you are like one of the many folks watching this video, not yet subscribed to this channel, please take a moment and turn that little red subscribe button to gray. Hit that like button, hit that notification bell, share this sucker out on the social medias, and of course, please do leave a comment before you head out the door today. Well, as we teased in the intro, MarketWatch is asking on its Disney earnings preview how much magic is left in Mickey Mouse's kingdom. Like a multi-billion-dollar albatross, ESPN has devolved from cash cow to cord-cutting victim as more people cancel their cable subscriptions and the costs of sports broadcasting rights rise. Last month, Disney chief executive Robert Iger said that ESPN was seeking a strategic partner and was open to selling an equity stake. The network, which is owned by Disney and led by Jimmy Pitaro, has talked to Major League Baseball, the National Football League, the NBA, and the National Hockey League. Already grappling with writers and actor strikes that have paralyzed production in Hollywood, Disney has also stumbled through recent high-profile box office misses. Among them, The Little Mermaid, Indiana Jones, and The Dial of Destiny, the loss of streaming subs over the past 2 quarters, and a steep decline in linear TV advertising that is roiling the industry. Throw in a political standoff with Florida Governor Ron DeSantis, and you have a 5-alarm corporate fire. Quote, "We are increasingly worried about advertising trends, given viewership trends remaining highly negative, declining around 10% year over year on average. This clearly bodes very poorly for forthcoming advertising revenues," Atlantic Equities analyst Hamilton Faber said in a note last month, in which he slashed his Disney price target to $76 from $113. Macquarie's senior media tech analyst Tim Nolan also trimming his price target 9% to $94. Too many near-term issues, he says, such as weak TV ad sales, DTC declines, softening parks trends, and the Hollywood strikes. Nolan also commented that, quote, "Disney's cost cuts may help to protect earnings, but these top-line issues are concerning." Disney's future is inexorably linked to Iger, who recently agreed to a 2-year contract extension through 26. Iger's restructuring plan is to slash $5.5 billion in costs, including 7,000 layoffs. And his deep institutional knowledge of Disney gives analysts hope that things will turn around. He told CNBC he was open to selling Disney's ABC broadcast stations, FX, and Nat Geo. Quote, "Iger staying until late 26 gives investors higher signal quality regarding Disney's path for the next 3.5 years, a reasonable investment time frame." And that was from Laura Martin of Needham Investments. My question is, what is that higher signal quality, as she puts it, really foreshadowing? Is it a higher signal quality that is garnering trust and faith and encouragement? Is Bob Iger remaining there for the next 3.5 years really the best thing for the Walt Disney Company? And is that actually coming across to investors and analysts out there? Are they really that satisfied that Iger is just going to hang around? We've heard this story before, all the way back in 2016. Too many complaints lately that the board failed at their job in the succession game. Trying to find somebody to replace Bob Iger on time at the end of 2024 now seems completely off the table after that extension. And maybe some of these folks should start wondering if he's ever going to leave at all. Because one thing a lot of these same folks are waking up to is the fact that most of Disney's problems right now were created by Bob Iger in the first place. And then we have this one from Business Insider. 3 key questions facing Disney CEO Bob Iger ahead of the Q2 2023 earnings. Now, that's calendar quarter 2, but fiscal Q3 for the Walt Disney Company. According to Insider, analysts are expecting another tepid quarter when Disney reports earnings on Wednesday. And that's actually what they guided towards in the last earnings call back in May. The company is facing a bevy of challenges affecting its streamers, ESPN, and long-term leadership. Business Insider spoke to analysts and experts about what they hope to hear CEO Bob Iger address. One former Disney employee who lost their job this year told Insider under the condition of anonymity that under Iger 2.0, morale had taken a hit and the layoffs were felt by many to have been hastily implemented. Quote, when you see the things that got cut and what you imagine the rationale must have been, it seemed ill thought through, this person said. Now, I have no idea who this unnamed source is, but sure would be funny if it was Christine McCarthy. In spite of Iger's moves, Disney continues to face hurdles like lagging share price that's down more than 20% over the past year. There's a lot of work to be done, Iger said last month in a statement tied to his contract extension. Now, but to Peter Sathey, the chairman of Creative Media and an mergers and acquisition advisor, Iger's return and contract extension ultimately are to make a transformative move, which he believes is to sell the company. Sathey sees Apple as the most logical buyer, but isn't counting out private equity either. Tom Staggs and Kevin Mayer, former top Disney executives who have reportedly been advising Iger in recent weeks, are backed by PE giant Blackstone through Candle Media, the company they founded back in 2021. Quote, what is the long game for any pure-play media company in a world where we have tech-driven media companies that are much larger than any traditional media company and have fundamentally different business models, Sathey said. Even mighty Disney has been overshadowed by these tech-driven media companies whose resources are so much more massive. Now, as I've said many times here on this channel, I find that an outright sale to somebody like an Apple is a relatively unlikely endeavor. But that may not be for lack of trying on the part of Disney or Apple, but that is something that ultimately would have to be given approval by the Federal Trade Commission and even perhaps the Federal Communications Commission if ABC goes along with it as part of the deal. And that may be one of the reasons that ABC is looking to be sold off from Disney right now. But I think the more likely situation for selling ABC is to try to get something now for that delivery system while it still has some value, as in 5 to 10 years from now, it might be worth nothing. But of the three key questions that Business Insider sees as the big ones for the earnings call today, how can Disney get its flagship streamer, Disney Plus, to profitability? Evercore is looking for Disney Plus to announce Q2 results in line with the previous quarter, when subscriptions declined 2%. And losses reached $659 million. They're expecting a repeat in what's about to get reported today. Equity researchers wrote in July 23 ahead of earnings, but Evercore also warned that plans for increased marketing could drive losses higher. Evercore predicts layoffs at the streamer could be ahead beginning in the fourth quarter. Paul Verna, a principal analyst at Insider Intelligence, told Business Insider that whether the company is still on target to meet its stated timeline for profitability, that is on Disney Plus, is, quote, a big question. Quote, if Disney doesn't either revise or confirm that target, meaning during this earnings call, obviously investors are going to ask more and more heated questions the closer that time gets. And yeah, I expect the Q&A session for this earnings call today to be just as fun as the last two. And then the second question is the one that I've been asking since Iger let this slip out during a CNBC interview almost a month ago now. Will Disney sell its television assets like ABC, and who could buy them? In another response from Paul Verna on this question, he told Insider that he was skeptical about the notion that private equity firms, which aim to acquire, fix up, and then sell businesses, usually after a few years, would want to scoop up Disney's TV assets. After all, the linear TV business is under siege. It's unclear whether such investments would be a smart play over the long term. Quote from Verna, when you're buying into a business that is suffering not because of any mismanagement, but just because the whole industry around it is dwindling, those are the secular headwinds that you often hear referred to, folks. He said he doesn't see any upside for a private equity deal, nor do I see the upside for any competitor to come in and buy it. And that's what I've been saying since the moment Bob Iger talked about selling linear broadcast over-the-air ABC. See, Bob Iger does not want to package in what he considers core Disney properties with any such sale. If somebody were to purchase ABC, they're not going to get headline Disney content right now. They're not going to get the sports packages. Disney's going to keep that at home and shift that to ESPN. That's going to be one heck of a breakup. And then you have to ask yourself, what is ABC actually really worth then? It's nothing more than an FCC license and a delivery mechanism, and it's one that Disney is trying to get rid of. Who would actually be able to take something like this? be they a competitor, be they an Apple, or be they a private equity firm. What could they possibly do with this long term in a market that is completely disappearing right now? And finally, who's going to prevail in the succession for Bob Iger's seat, now 3.5 years away? And of course, in the article, they go on to talk about how Mayer and Staggs themselves were once the top candidates just about 7 years ago. And they are now back at Disney, at least as contractors, helping Bob Iger navigate what type of assets to sell and how to do it. Or at least that's what's being discussed. For those two Disney veterans, Staggs and Mayer, Iger speculated that the return might amount to a trial run of sorts. If Iger is seeking their counsel, could it position one of them to be a contender again? He also added that their unexpected recruitment recently could have been, quote, somewhat disappointing for internal figures thought to be in line for the throne, like Dana Walden and Alan Bergman. But rather than placate investors' anxieties about Disney's future, both Iger and Verna said that Iger's 2-year extension might only exacerbate them. It only suggests that the company has no clear contender to whom Bob Iger could pass the torch. Verna said naming a successor too soon could spell other troubles, like sidelining Bob Iger as a lame duck or ruling out other possible contenders. But he did add, quote, you do have to be transparent about the process, and I don't think they have been. And Fortune magazine's headline says it all. Disney's earnings call could either make it the streaming queen of the ball or just another struggling media company. And even Fortune knows the big focus is going to be on streaming. How close is it getting to profitability? Has there been any meaningful move towards that zero marker of break even before hopefully one quarter in next fiscal year 2024 actually seeing a positive number next to the operating income for Disney+? Certainly the strikes and the theme park business are going to play a key piece of this earnings call as well. And these are just things we're going to have to wait for to see how they pan out. But what's even more important than what happened in the quarter that they report is going to be what they guide forward to. What is Disney expecting in this current fourth fiscal quarter that they're in right now? What about the first fiscal quarter, which would be October 1st through December 31st of this year? We need to hear some long-term information to see how this is going to play out, because nothing seems to be working right at Disney right now. Now, certainly releasing news like this at the end of the trading day is designed to help give Disney a boost. And they did this on Tuesday, August 8th, striking a deal with Penn, one of the largest online sports books in the country, operating in 16 states. Basically, Penn is going to be paying the Walt Disney Company $2 billion, about $1.5 billion in cash and another $500 million in stock warrants over the next 10 years. And what that's going to get Penn is the right to use the ESPN brand name, rebranding the Penn Sportsbook to ESPN Bet. Now, what's interesting about that is that if Bob Iger is trying to line up somebody to come in and take a piece of ESPN from an equity position, this might make things a little bit more attractive for a league, or maybe less attractive for a league that doesn't want to have anything to do with gambling. But that's kind of one of the nice things about how this deal works out. The Walt Disney Company is itself not engaging in any type of sports betting. They are simply licensing out the ESPN brand name to a major national sports book. All of this will come to a head during the earnings call this afternoon. Make sure you check out the live show right now. Set the notifications up. We hope to see you then. We will begin at 4 p.m. Eastern, and you can check out WDW Pro's YouTube channel at 3 p.m. Eastern with a pre-show before we get going. Hope to see you there. Leave a comment below before you head out the door. Give me your thoughts, what you're expecting today. And until then, take care.